Hello, welcome to Insignia Investments. My name is Roop Pratim Datta, and today I'm going to discuss with you the cement industry as an option for short term profit booking. The Ministry of Commerce and Industry publishes the Index of Industrial Production, popularly known as the IIP, every month, as it is a leading indicator of things to come in the economy. Eight sectors in the IIP constitute nearly 40.27% of the index, making them quintessential parts of the modernized industrial economy of India. These are quintessential not only because of the fact that they churn the mechanized industrial machine, but also because of the fact that they employ a substantial portion of the country. These eight sectors are coal, crude oil, natural gas, refinery products, fertilizers, steel, cement, and electricity. So, when there are eight indefatigable industries powering the nation, why should we turn our gaze to the cement sector only? Because the index that the government published on the growth in each of these sectors shows that momentous growth has taken place on the leading indicator side of the cement industry. To support the same, consider the following index growth rate table published by the Ministry of Commerce and Industry. It is evident that the 13.6% growth in the cement industry skews the IIP. And being an IIP starved nation, the market will welcome the same as a breath of fresh air. The overarching growth in the cement industry will then manifest itself as the reaper of the largest harvest, dividends, and price appreciation. It is with this premise that we begin our fundamental analysis of the cement industry. Now, what are the forces that have actually bolstered this tremendous growth in the cement industry? At the forefront of it is the sheer size of the industry. It cannot be forgotten that India is the second largest producer and consumer of cement across the globe. This means that a ready market is available to pay for its consumption needs. Add to this the massive market size, the fact that this sector has a high level of correlation with the construction industry, which is the second largest employer of the population after the agriculture and allied services industry, and you soon figure out that cement as a product is too big to fail. This provides cautious investors protection that is seldom afforded by the market. The Indian cement industry has more than 400 plants, 210 of which account for nearly 80% of all annual cement production. Moreover, the top 40 companies in the sector cater to nearly 90% of all the demand. Secondly, there is the election fever. Every time the parliament goes about to fill its seats, the easiest way they find to commit to the people their services is by offering infrastructure. We are an infrastructurally developing nation, and there is room for a tremendous amount of improvement. The government finds the mobilization of cement, sand, rock, and labor the most economical way to get the growth engine churning before every election. The same is the story with this year's momentum. The government has committed itself to many infrastructural growth stories like housing for all by 2022, the dedicated freight corridor, smart cities, high speed railways, roads, bridges, dams, etc. All this has provided a major impetus to the demand for cement and the growth in the cement industry. Next, there has been an improvement in the impediments that were there in the cement industry during FY 2018 that has resulted in better efficiency in the cement industry, like higher axle loading, removal on the ban of pet coke utilization in the cement kilns located in northern India, volatile crude prices, etc. It is to be noted that there is a regional concentration in the cement industry. There are two specific reasons for the same. Firstly, limestone reserves are majorly located in belts across Rajasthan in the north, Madhya Pradesh in the center and west, and Andhra Pradesh in the south. And secondly, the low shelf life of cement. The cement hardens and solidifies into a mass of rock if kept in contact with air for a decent amount of time. Due to these reasons, cement is procured, produced, and supplied locally across India, dividing the market in north, east, west, south, and central. And finally, the cyclicality of the cement industry. The fourth quarter is always the best quarter for the construction industry. Most construction activities are slow during summers and monsoons, with major activity picking up after Diwali. All management calls have given the investors a positive outlook for demand during Q4 FY 2019. and the government's focus on the infrastructural growth story has not been shaken. The same can be expected to hold good, at least till the monsoon session of the parliament. The future of the same, though, is dependent on the incoming government. So now that we are convinced about the wealth generation capacity of the cement industry in the near future, we may ask the question as to which stock deserves the warmth of your money. The first criteria to select the stock is to have all the following three ticked by the company: strong backward integration of operations, which includes limestone mines, coal linkages, captive power sources, etc., large distribution network, and pricing power. So, which stock to buy? I have shortlisted six stocks based on their market capitalization, the price of an individual piece of stock, so that an ordinary individual investor can buy the share, and availability of public information in addition to the above three. In the following list of comparative analysis, we see that Ultratech Cement is highly overvalued, and rightly so, considering the sheer production capacity of the company. Ambuja, JK, and ACC are slightly undervalued, while Heidelberg and Ramco are slightly overvalued. The following graphs plot the quarterly performance of each of these companies, and we see a trend where most of the large players have stabilizing margins. Ramco has shrinking margins, while Heidelberg has a moderate upward trend in margins. If you want to look at these stocks and their performance over a longer span of time, consider pausing the video here. Going forward, all these six stocks are good stocks and will earn you money when the results come out. They are among the top 10 players in the industry with considerable pedigree backing them up. However, I wish to go an extra arm's length and suggest Heidelberg. It is already visible that the margin of Heidelberg is showing an upward trend. But once we plot the performance of all these stocks against the benchmark, Nifty, the reason to hold Heidelberg for the short term becomes even stronger. Now look at this graph. It is the only stock to have outperformed the Nifty during FY 2018. This is because of the fact that the market expects this company to perform. The company belongs to Heidelberg AG of Germany, which has a global footprint in the cement market and a sufficiently strong balance sheet. Now, you might say that the slight overvaluation in PE shows that the market knows there is higher certainty in Heidelberg to reach the estimated performance, and thus the market is willing to pay a slight premium to own the stock. The market has also discounted the above fact to help it beat the Nifty. But what makes Heidelberg a great choice is the fact that while Ramco is twice the size of Heidelberg, the stock commands the same certainty premium in PE. This means that when the company reaches the estimated performance, the smaller size of the company will compel the management to explore expansion, which is when the stock will gain further price appreciation and momentum. The present momentum will also be bolstered by a good Q4 results, which will in turn help you book the short term profits. But the extra protection that Heidelberg provides in the smaller size of the company will help you make a safe return in the future in case the present performance falters, which, in my opinion, is highly unlikely. Now, consider another graph that shows why Heidelberg is so attractive: this capture ratio sheet. This is evident from the following plot of the capture ratios, which shows that Heidelberg is the only stock among its peers to have a higher upside bias compared to a downside bias, which means that when the market moves up by 1 point, Heidelberg is likely to move up by more than 1 point, while the market, when it comes down by 1 point, Heidelberg is less likely to come down by a similar 1 point. Considering the rising Nifty and Sensex at present, the market forces itself pose to be a great force to help Heidelberg deliver the short term profits you seek. And with that, we come to an end to this discussion. I hope that this analysis will help you gain better clarity of the industry and add value to your portfolio creation. If you have liked this video, do consider subscribing to our channel. I try to bring a fresh analytical process to investing. You can also visit our website at www.insigniainvestment.wixsite.com/home. The link is in the description box below. You can also reach out to us at insigniainvestments@gmail.com. Thank you for your patience. This has been Roop Pratim Datta, your ordinary individual investor, signing out till next time. Happy investing.